The ratio between registered silver inventories and open interest contracts has remained structurally below 1-to-1 for extended periods. In contrast, delivery obligations have continued to be settled through offset mechanisms rather than physical transfer. This analysis reconstructs how reported coverage diverged from physical reality within a centralized exchange framework. Administrative systems tend to project stability not through declarations, but through repetition. Reports are filed, inventories are listed, categories are maintained, and the cadence of disclosure becomes familiar. Over time, this familiarity creates an assumption of completeness. When figures are published regularly and without interruption, the act of publication itself begins to substitute for verification. The structure does not demand belief. It produces it indirectly through continuity. In commodity markets, this effect is amplified by technical language. Terms such as registered, eligible, open interest, and delivery month function as neutral descriptors. Yet they encode assumptions about availability and coverage. These assumptions are rarely examined by participants who interact with the system primarily through price exposure rather than physical settlement. The exchange, in this context, becomes an abstraction layer. It mediates between contracts and metal, between obligation and fulfillment, without requiring most participants to cross that boundary. Over decades, the system evolved to prioritize liquidity and efficiency. Contracts multiplied faster than inventories. Netting mechanisms expanded. Delivery became optional in practice, even if mandatory in theory. None of this required concealment. It required only that incentives remain aligned toward continuation rather than inspection. As long as settlements cleared and volatility remained within tolerable ranges, structural questions stayed peripheral. The administrative appearance of coverage depends less on the quantity of metal than on the absence of demand for it. When contracts are rolled, offset, or closed financially, the question of physical sufficiency never materializes. The system operates smoothly precisely because it is not stressed at its physical boundary. Under such conditions, reported inventories function as reference points rather than constraints. This normality is reinforced by the compartmentalization of responsibility. Clearing members rely on exchange rules. Exchanges rely on vault operators. Vault operators rely on classification standards. Each layer fulfills its procedural obligations. No single layer is tasked with asking whether the aggregate structure closes materially under stress. The absence of that question is not an oversight. It is a feature of specialization. At no point does the system require participants to assume that every outstanding contract could be fulfilled simultaneously. The model assumes behavior, not contingency. It assumes that most positions will be resolved financially, that delivery demand will remain marginal, and that confidence will persist. These assumptions are not hidden. They are embedded. The question that reorganizes the entire structure is not whether silver inventories declined or whether contracts increased. It is whether the exchange ever functioned as a fully covered system in physical terms, or whether coverage was always a representational concept rather than a material one. This question does not accuse. It reframes. Once this framing is applied, the familiar metrics change meaning. Inventory reports no longer describe capacity. They describe classification. Coverage ratios no longer measure sufficiency. They measure tolerance. The system's resilience is no longer defined by metal availability, but by participant behavior and regulatory acceptance. This analysis operates within publicly available data and documented procedures. It does not project outcomes, assign intent, or evaluate desirability. It reconstructs structural mechanics and examines their internal consistency under stated rules and observed behavior. All interpretations remain bounded by verifiable disclosures and established operational frameworks. In early 2024, a sequence of vault reports showed a sustained divergence between total open interest in silver futures and the quantity of metal classified as registered for delivery. While this divergence was not unprecedented, its persistence coincided with unusually low conversion rates from eligible to registered categories. At the same time, delivery months continued to settle without disruption, primarily through financial offset rather than metal withdrawal. The reported figures indicated that a large proportion of listed silver remained classified as eligible, meaning it met exchange specifications but was not designated for delivery. This distinction is procedural, not physical. The metal exists, but it is not committed. Conversion requires owner consent. The exchange cannot compel it. Therefore, the presence of eligible inventory does not equate to deliverable supply. What drew attention was not a sudden depletion, but the stability of this configuration. Registered inventories remained comparatively thin, while open interest expanded and contracted within normal ranges. Delivery volumes remained manageable, not because inventories grew, but because delivery demand stayed contained. The system continued to clear because behavior aligned with structure. Simultaneously, historical vault data revealed that periods of higher registered coverage were exceptions rather than the rule. Over long intervals, the The exchange operated with coverage ratios that would be insufficient under universal delivery assumptions. Yet universal delivery never occurred. The model never required it. This pattern suggests that the exchange's functional solvency is behavioral, not material. As long as participants treat contracts as financial instruments rather than claims on metal, the system remains coherent. The Vault report does not contradict this. It confirms it. The implication is not that the exchange failed. It is that its purpose has long diverged from literal physical intermediation. The exchange facilitates price discovery and risk transfer. Physical delivery is a residual function activated by a minority of participants. The inventory system supports that minority, not the total contract base. Under this interpretation, the notion of full coverage becomes a category error. The system was not designed to be fully covered in physical terms. It was designed to clear obligations under expected behavior patterns. The Vault report, when read without legacy assumptions, aligns with that design. This reframing also explains why stress narratives periodically emerge without resolution. Each time delivery demand rises modestly, inventories adjust at the margin. Eligible metal is reclassified, incentives shift temporarily, then behavior normalizes. The system absorbs the perturbation without structural change. What is different now is not the data, but the scrutiny. Increased transparency, independent aggregation, and broader dissemination of Vault statistics have allowed observers to reconstruct coverage dynamics over time. When these dynamics are viewed longitudinally, the absence of full coverage appears consistent rather than anomalous. This does not imply fragility, it implies conditional stability. The condition is behavioral continuity. As long as the majority of participants remain indifferent to physical settlement, the system functions as intended. The Vault report does not signal a break. It documents an equilibrium. Understanding this equilibrium requires abandoning binary notions of backed versus unbacked. The exchange exists in a hybrid state where physical metal anchors credibility, but financial settlement sustains scale. The anchor does not need to support the entire structure. It needs only to be sufficient for observed demand. The unannounced shift, therefore, is not a change in policy or disclosure. It is a shift in interpretation. The data did not reveal a moment when coverage failed. It revealed that coverage was never the operative principle. The operative principle was clearance. From this point forward, analysis must account for this reality. Questions about inventories must be paired with questions about incentives. Questions about delivery must be paired with questions about participation. Without this pairing, conclusions will continue to misalign with observed outcomes. The Vault report does not close the system. It opens it analytically. It allows the structure to be examined without inherited assumptions. What follows is not a prediction, but a reconstruction of how such a system emerged, stabilized, and persists. To understand how this equilibrium emerged, it is necessary to situate the modern silver futures system within a longer historical cycle of commodity exchange design. Organized futures markets did not originate as mechanisms for warehousing metal. They emerged as tools for coordinating expectations across time, allowing producers, merchants, and intermediaries to transfer price risk without transferring goods at the moment of contract formation. Physical settlement existed, but it was never the dominant function. It was the boundary condition that legitimized abstraction. In earlier commodity regimes, physical scarcity imposed direct limits. Warehouses filled and emptied visibly. Settlement failures were localized and reputational. As markets expanded and participation widened, the need for standardization overtook the need for physical immediacy. Contracts became uniform. Clearinghouses centralized counterparty risk. The physical asset receded into the background, not because it disappeared, but because its role shifted from transaction object to reference anchor. Silver occupies a distinctive position in this evolution. Unlike purely financial assets, it retains industrial, monetary, and strategic characteristics. Unlike agricultural commodities, it does not perish and can be stored indefinitely. These properties made silver particularly suited to financialization. Once vaulted, it could support repeated layers of contractual reference without being consumed. Over time, this capability enabled the growth of paper claims far in excess of routine physical movement. The post-war expansion of futures markets accelerated this process. Regulatory frameworks prioritized market integrity through margining, daily settlement, and disclosure, rather than through physical backing ratios. The assumption was that price continuity mattered more than deliverability at scale. Delivery was preserved as an option, but not as a systemic requirement. This distinction is critical. Optional mechanisms behave differently from mandatory ones, especially under stress. As global silver markets integrated, centralized exchanges became nodes of reference rather than hubs of distribution. Price discovery consolidated, even as physical flows diversified geographically. Vaults attached to exchanges did not need to house global supply. They needed only to service marginal delivery demand from participants who chose that path. The rest of the market transacted on expectation alignment. Throughout successive decades, this architecture proved resilient under normal conditions. Periods of heightened delivery interest occurred often during monetary uncertainty or industrial demand shocks, but they remained episodic. Each episode reinforced the same lesson. Incentives could redirect behavior faster than inventories could constrain it. When delivery pressure rose, spreads adjusted, premiums emerged, and financial settlement regained appeal. This adaptive behavior reduced the need for structural change. The system learned to self-stabilize by influencing choices rather than enforcing constraints. In this context, registered inventory levels functioned less as guarantees and more as signals. They indicated readiness to meet expected delivery, not theoretical maximums. Observers who interpreted them as coverage metrics misunderstood their operational role. The classification system itself reflects this logic. Eligible silver is compliant but uncommitted. Registered silver is committed but revocable. Movement between categories is administrative, contingent on owner preference. This fluidity allows the system to expand or contract deliverable supply without altering total inventory. It also ensures that the exchange never claims more than it controls procedurally. The absence of a requirement for full coverage is not an omission. It is a design choice inherited from decades of market evolution. Full coverage would imply immobilized capital, reduced liquidity, and higher transaction costs. The system trades these outcomes for scalability and efficiency, accepting conditionality as the price. From a structural perspective, this places the exchange within a broader class of systems that rely on probabilistic fulfillment. Not every claim is expected to be exercised simultaneously. The system functions because exercise rates remain low and predictable. Stress emerges only when behavior deviates sharply from historical norms. Mathematically, this resembles reserve banking rather than custodial storage. The parallel is not exact, but the logic is similar. Confidence and continuity substitute for full backing. Transparency and regulation substitute for physical redundancy. The system is stable until assumptions are challenged, and even then, it adapts by altering incentives. The silver futures market has encountered such challenges before. Episodes of concentrated delivery demand have tested vault capacity and classification flexibility. Each time, the response has been incremental rather than transformative. Margins adjusted, spreads widened, participation shifted. Physical settlement receded again. The core architecture remained intact. What differentiates the current period is the accumulation of data rather than a rupture in function. Historical vault reports, when assembled longitudinally, reveal patterns that were previously obscured by fragmentation. These patterns show that low registered coverage is not an anomaly, but a recurring baseline. High coverage periods correspond to specific incentives, not structural norms. This realization reframes debates about adequacy. The relevant question is no longer whether inventories are sufficient in absolute terms, but whether the system's incentive mechanisms remain effective at modulating behavior. As long as they do, the exchange can operate with thin physical margins. When they do not, stress manifests not as immediate failure, but as behavioral reallocation. Understanding this dynamic requires abandoning static interpretations. Inventory snapshots cannot be read in isolation. They must be contextualized within participation patterns, contract structures, and settlement preferences. Without this context, conclusions will continue to oscillate between alarm and dismissal, neither of which captures the system's actual mechanics. At its core, the modern silver exchange is a coordination device. It aligns expectations across time horizons, industries, and geographies. Physical metal underpins this alignment symbolically and operationally, but it does not scale with contract volume. It scales with delivery demand, which remains a fraction of total exposure. This distinction explains why the system has persisted without reform despite periodic scrutiny. There is no internal signal indicating failure. Obligations clear, prices form, volatility is absorbed. From an operational standpoint, the system performs its primary functions. The absence of full coverage does not impede these outcomes. The implications of this structure are subtle but significant. They suggest that risk resides not in inventory depletion alone, but in shifts in collective behavior. A widespread revaluation of delivery preference would stress the system more than any single vault report. Conversely, stable behavior renders thin inventories inconsequential. The mathematical constraints underlying this system do not appear at the level of daily operations. They emerge only when hypothetical scenarios are imposed, such as universal delivery. These scenarios are analytically useful, but operationally irrelevant unless behavior changes. The system is not built to satisfy hypotheticals. It is built to clear reality. This does not absolve the structure of limitations. It clarifies where those limitations reside. They are not hidden in undisclosed shortages. They are embedded in conditional assumptions. As long as those assumptions hold, the system remains coherent. When they do not, adjustment precedes breakdown. The historical record suggests that adjustment is the dominant response. Markets adapt before they fail. Incentives shift before inventories exhaust. The exchange's longevity attests to this adaptive capacity. The Vault report, when placed in this context, reads not as a warning, but as a data point within a long-standing equilibrium. What follows from this understanding is not a conclusion, but a framework. It allows subsequent analysis to focus on mechanisms rather than metrics, on behavior rather than balances. It prepares the ground for examining where mathematical constraints eventually surface, not in theory, but in practice. As the system progresses beyond its initial equilibrium, its later stages are defined less by expansion and more by convergence. Growth in contract volume eventually stabilizes, not because demand disappears, but because the exchange reaches a mature role within the broader financial architecture. At this stage, marginal changes matter more than absolute scale. Small shifts in behavior can propagate through the system with disproportionate effect. In this advanced phase, the distinction between physical and financial silver becomes increasingly operational rather than conceptual. Market participants internalize the probabilistic nature of delivery. Contracts are evaluated primarily as instruments of exposure, hedge, or liquidity provision. Physical settlement becomes a specialized pathway, utilized by participants with specific logistical or strategic requirements. The majority operate entirely within the financial layer. This bifurcation allows the system to maintain coherence under conditions that would appear unstable under a purely physical interpretation. The convergence occurs not toward full backing, but toward behavioral consistency. The exchange does not require that all participants share the same expectations. It requires only that expectations remain distributed in a predictable pattern. Over time, this pattern becomes self-reinforcing. Participants who seek physical metal learn to navigate incentives, premiums, and timing. Participants who do not seek delivery learn that settlement is reliable without it. Each group acts in ways that confirm the system's assumptions. The architecture persists because it is continuously validated by use. At this stage, the role of reported inventories is primarily communicative. They signal that the physical pathway remains open, not that it is universally available. The numbers are sufficient to satisfy observed delivery behavior. They are not designed to withstand hypothetical surges detached from historical precedent. This is not a vulnerability in isolation. It is a boundary condition. The mathematical closure of the system depends on this boundary. If delivery demand remains a small fraction of open interest, the system closes. If it approaches total open interest, it does not. This is not a revelation. It is an explicit trade-off embedded in the design. The system chooses efficiency over redundancy. From a numerical standpoint, this can be expressed simply. Let total contracts represent claims on future delivery, while registered inventory represents immediately deliverable metal. If the expected exercise rate remains below available inventory, obligations clear. The system does not require inventory to equal claims. It requires expected claims to remain below inventory. The difference between these two conditions is the essence of the structure. This expectation is not arbitrary. It is derived from decades of observed behavior. Delivery rates cluster within narrow bands. Even during periods of stress, they do not approach total open interest. The system's margins, rules, and incentives evolved around this empirical reality. Mathematical sufficiency is defined relative to expectation, not possibility. The impossibility emerges only when possibility is mistaken for requirement. If one assumes that every contract must be deliverable simultaneously, the system fails on paper. If one assumes that behavior will follow historical distributions, the system remains viable. The exchange is built on the latter assumption. It does not deny the former. It simply does not optimize for it. This distinction becomes critical when projecting forward. Future scenarios are not binary outcomes. They are paths shaped by participation, regulation, and external conditions. A gradual increase in delivery preference would manifest as rising premiums, tighter spreads, and increased reclassification of eligible metal. A sudden shift would stress these mechanisms more rapidly, but still through behavior first. Historical precedent suggests that markets respond to such stress through repricing rather than rupture. Delivery becomes more expensive. Financial settlement becomes more attractive. Participation reallocates. These adjustments occur before physical exhaustion. The system's flexibility lies in its ability to change the cost of behavior rather than enforce constraints. This does not eliminate risk, it relocates it. Risk resides in the potential for synchronized behavioral change that outpaces incentive adjustment. Such synchronization is rare, not because it is impossible, but because participants are heterogeneous. Their objectives, constraints, and time horizons differ. This diversity dampens collective shifts. External factors can influence these dynamics. Regulatory changes, monetary policy shifts, or disruptions in physical supply chains can alter preferences. However, even under such influences, behavior tends to adjust incrementally. The exchange's structure absorbs these changes through price and participation before inventory becomes the limiting factor. Counterarguments often focus on the moral hazard of thin coverage. They question whether confidence can persist indefinitely without full backing. This critique is structurally valid but operationally incomplete. Confidence in the system is not blind. It is conditional and continuously tested through clearing and settlement. As long as obligations are met, confidence renews. Another counterpoint concerns transparency. Increased visibility into vault data allows external observers to apply alternative assumptions. This scrutiny can influence perception, but perception alone does not alter mechanics. Only behavior does. Awareness may change incentives at the margin, but it does not mandate collective action. There is also the argument that reliance on financial settlement undermines the connection between price and physical reality. This concern reflects a philosophical preference rather than a structural flaw. Price discovery in modern markets reflects marginal transactions, not total inventories. This has been true across asset classes for decades. The system's strength and limitation are the same. It is robust under expected behavior and fragile under extreme coordination. The exchange manages this trade-off through rules, margins, and incentives, not through inventory accumulation. This choice reflects priorities that favor liquidity and participation over absolute certainty. As the system moves forward, monitoring becomes more relevant than prediction. The variables that matter are not inventory totals alone, but delivery rates, classification flows, premium structures, and participation patterns. These indicators reveal whether assumptions remain aligned with behavior. The unannounced shift, therefore, resolves into a clearer understanding. The Vault report did not expose a hidden failure. It clarified an existing design. The exchange was never structured as a fully covered warehouse. It was structured as a clearing mechanism with optional physicality. Interpreting it otherwise imposes a framework it was not built to satisfy. This understanding does not demand action. It demands accuracy. Analysis that aligns with structure avoids false alarms and misplaced assurances. It recognizes that stability is conditional and that conditions are observable. The system does not promise permanence. It promises continuity under stated assumptions. The appropriate response to this realization is not conclusion, but observation. As long as the system continues to clear, its internal logic remains intact. When that logic is challenged, the challenge will manifest through behavior before it manifests through depletion. What remains is a commitment to ongoing examination. The data is available. The mechanics are documented. The assumptions are implicit but discernible. This analysis reconstructs the system as it is, not as it is imagined. Monitoring replaces speculation. Structure replaces narrative. The exchange does not announce shifts. It reflects them. Those reflections are visible to those who examine the system longitudinally rather than episodically. Continuity is not guaranteed, but it is measurable. That measurement is the only meaningful closure.